So here's a couple of questions for you if you are actually thinking about dumping some of your hard-earned money into an index annuity or equity indexed annuity. How much do you think an index annuity will earn as a return on investment when it's all said and done? And if you think you know the answer or have a good idea, you probably have been lied to by the commission-based advisor who's trying to sell you that annuity, because index annuities are so complex that calculating returns is impossible for investors to figure out. And the insurance company can change the formulas and terms to calculate your returns at any time. And according to one unbiased expert on annuities, even with interest rates near record lows, CDs may still wind up doing better than annuities because insurers may have to reduce caps in order to maintain profitability. In other words, insurance companies can change the rules of the game in the middle of the game to make sure that they come out the winner, and that's even after all of their expenses and overhead costs. Yes, they're actually allowed to do that. That's what happens when you have a product that's not regulated by the SEC. And my second question for you is, whatever rate of return on investment you think you will get, how on earth do you think the insurance company will pay for it? Keeping in mind that the insurance company has to pay your so-called advisor as much as 5 to 20% for a commission, and insurance companies have tremendous overhead costs, including legal and lobbying costs, etc. Insurance companies are also for-profit corporations. They aren't selling annuities with the expectation of losing money or breaking even. They aren't playing Santa Claus. Again, according to this expert, index annuities actually tend to underperform a lower risk strategy of simply rolling over CDs. So again, let's assume you are just repelling all this information, and then think about it this way. What if we were to sort of reverse engineer what the insurance company does with your money? Well, according to this article in Bloomberg, all they do is invest some 90-odd% of it in bonds, which anybody can do, and then they simply invest the few percent more of your money in a portfolio of derivatives linked to the S&P 500 index, which, of course, anybody can do. We're talking about derivatives such as index funds like SPY or VOO. Any third grader can invest in a couple of bond and stock ETFs and not have to worry about locking their money up for 10, 15, or 20 years under threat of a contingent deferred sales charge. Remember, an annuity is a long-term commitment because of the insurance company's surrender charge, because of the pre-59.5 federal and state tax penalties, and because of the escalating ordinary income tax rate that you would have to pay if you were to take out lots of money from an annuity in any given year, rather than staggering payments over several years. So basically, if you just invest in a total bond market index ETF and an S&P 500 index ETF, history says that you're going to easily do better than an index annuity, and you maintain your liquidity. If you need all of that money all at once, you can sell at any time for any reason without penalty. ETFs can be bought and sold through any deep discount brokerage firms such as E-Trade, Ameritrade, or Scottrade for less than $10. And profits are taxed at the normal and lower capital gains tax rate. And if you allocate a large percentage into bonds rather than stocks, history has shown us that you're not going to lose your life savings like Mr. Advisor keeps suggesting to you. Commission-based advisors are very adept at making you fearful of the stock market and making you think that you need to lock your money up in an annuity prison. So basically what it boils down to is annuities are sold to investors who are ignorant of bonds and how diversification into bonds protects against stock market volatility. And if you're retired and you can't handle the type of stock market crash that happens every 50 years like we had in 2008, then you shouldn't have 100% of your money in stocks. You're taking on way too much risk. Instead, you should have something more like 28% stocks and 72% bonds. But don't expect Mr. Commission-based Advisor to educate you about diversification into bonds, because diversification is bad for his business of selling commission-based products like annuities. Anyway, if you need help investing, I recommend that you go to all of these 4 websites that I have listed in the text description below this video. And if you're still thinking about dumping your hard-earned money into an index annuity, I also strongly suggest that you read this Bloomberg article found also in the description below this video. Also, be sure to view some of my other videos, such as Equity Index Annuity Guaranteed 7% Return, a Lie. Insurance salesmen are very skilled at confusing you into thinking that annual interest rate is somehow the same as what really matters, your total return on investment, or confusing protected benefit value or accumulation value as being what really matters, your actual cash surrender value or your heirs' inheritance value.